As you can see in this chart, since the United Kingdom's decision to leave the European Union in 2016, the nation's economic landscape has been doing worse than all of the other economies it has been competing with. But how bad can it really get? Well, this shows how bad it's already gotten, as UK reportedly had the worst economic growth rate out of all its competitor countries. Concerningly, by 2035, projections suggest that the UK investment could plummet by over 32% compared to what it might have been if the country had stayed in the EU. Here's the big question. What exactly has caused such a dramatic downturn, and is there any way to turn back from this? To find out, we're about to get into the real consequences of Brexit. After the 2016 referendum, while other big economies were growing steadily, the UK seemed stuck in place. As shown in this chart, by early 2023, the Office for National Statistics reported that business investment in real terms was still 1.2% below what it had been in the third quarter of 2016. Think about that. Almost 7 years had passed, and the UK hadn't even caught up to where it was before Brexit. And there's more to the story. The Tony Blair Institute for Global Change dug deeper and found something even more troubling. Business investment in the UK is now 31% behind the path it was on before the referendum. Before Brexit, the UK was seeing a steady rise of 1.7% in business investment every quarter. So what went wrong? The main issue is ongoing uncertainty. For years after the referendum, businesses didn't know what to expect. Questions about trade deals, market access, and regulations went unanswered for too long. This lack of clarity froze decision-making. The Bank of England even called it a chilling effect, where companies either delayed or cancelled their investment plans entirely. Then, when the rules did become clearer, they brought new trade barriers that weren't helpful for businesses. These new barriers with the EU, still the UK's biggest trading partner, added costs and complicated logistics, making it harder for companies to operate smoothly. Many businesses simply couldn't keep up. For industries that relied on easy cross-border trade, these changes turned everything upside down, making the UK a less appealing place for investors. But it wasn't just about trade. Brexit also caused chaos in the job market. Many skilled workers, especially those from the EU, started leaving the UK in large numbers. With stricter immigration rules and fewer foreign workers coming in, businesses faced a shortage of skilled labor, which hurt productivity and growth. This flowchart sums up what's really happening with UK's productivity. The European Central Bank even warned this labor shortage could hold back the UK's economy for years. The UK's struggles became clearer when compared to other major economies like the G7 nations. While countries like the US and Germany have seen strong growth in business investment over recent years, the UK's progress has been surprisingly weak. When you look at specific industries, the picture gets even worse. In manufacturing, businesses are seeing one of the biggest drops in new orders since the COVID-19 pandemic. Demand is drying up, and the chances of making good returns on investment are looking grim. Even financial services, a key part of the UK's economy, are struggling. London, once seen as a top global financial hub, is losing its edge. Stock market values in London have dropped noticeably, showing just how much has changed since before Brexit. Let's start with a number that says it all. Back in 2013, there were 118 UK companies among the top 2,000 global spenders on research and development, R&D. By 2023, that number had almost been cut in half, with only 63 companies left on the list. So what happened? If that drop doesn't sit right with you, here's something even more striking. In the same 10 years, the United States increased its top R&D companies from 778 to 881, and China's numbers shot up from 114 to an unbelievable 678. While other countries raced ahead, the UK fell behind, and Brexit played a big role. This isn't just about rankings, it's about the money too. In the chart below, according to the Office for National Statistics, UK businesses spent 3% less on R&D between 2022 and 2023, dropping from £51.5 billion to £50 billion. That's a loss of £1.5 billion in just 1 year. If you look further back to 2021, the total drop adds to £3.4 billion, a 6% fall. Meanwhile, the rest of the world is spending more. Between 2021 and 2022, global R&D spending went up by 5%. The UK, however, was one of the few major economies going in the opposite direction. This decline is making it harder for the UK to compete in new technologies, with artificial intelligence being a clear example. The UK has a strong academic background in AI research, but businesses aren't investing enough in it. Experts warn that without more private sector funding, the UK could lose out on the huge opportunity AI offers. While companies around the world are spending billions on AI, the UK risks falling further behind without a serious boost in R&D spending. But the issue isn't just about AI, it's about the UK's overall ability to stay competitive in industries that drive growth. The UK is great at scientific research, but it struggles to turn that research into industrial success. Many innovations created in UK labs are turned into products and profits in other countries. This means other nations benefit economically, while the UK misses out on growth, high-paying jobs, and influence in important industries. Nowhere is this issue more obvious than in the pharmaceutical industry. The UK used to be a world leader in pharmaceutical R&D, but its share of global investment in the field has dropped by 1/3. Industry leaders are warning that without strong government support and better policies, big pharmaceutical companies might move their R&D work to other countries. This isn't just bad for the pharmaceutical sector, it's bad for the whole economy, given how much the industry contributes to jobs and GDP. To address this, the UK government has promised to increase public R&D spending to £20 billion a year by 2024 to 2025. That sounds like progress, but the reality is more complicated. Recent cuts to R&D tax credits and other policy changes could cancel out much of this planned increase. On top of that, there's the risk of budget cuts to the Department of Science, Innovation and Technology. Over 40 research and industry groups have already warned that these cuts could hurt the UK's entire innovation strategy, making it even harder for the country to compete globally. In this chart, you can see that between 2021 and 2023, UK exports of goods to the EU dropped by a huge 27%, while imports from the EU fell even more, down by 32%. This isn't just about percentages, it's billions of pounds disappearing from trade. In 2023, the EU still made up 42% of all UK exports, worth £356 billion, and 52% of its imports valued at £466 billion. But these big numbers hide a tough reality. The UK's trade connection with its closest partner has taken a serious hit. The details are eye-opening. The Office for National Statistics reported that UK goods exports to the EU shrank by £11.5 billion in 2023 alone. And it wasn't just trade with the EU that suffered. Exports to countries outside the EU also dropped by £5.9 billion in the same year. Compared to 2018, total goods exports were down by 12.4% by 2023, with both EU and non-EU markets seeing these declines. It's a clear sign of an economy struggling to bounce back. Imports tell a similar story. In 2023, total goods imports fell by £37.8 billion, a 7.4% decrease from 2022. Most of this drop came from non-EU countries, but the effects were felt everywhere. And while trade was struggling, the overall economy wasn't doing much better. From late 2019 to the middle of 2024, the UK's GDP grew by only 2.4%. At first glance, that might seem okay, but compared to other G7 nations, it's near the bottom of the pack. Only Germany performed worse, with just 0.2% growth during the same period. When you factor in population growth, the numbers look even worse. By mid-2024, the UK's GDP per person was still 0.4% below what it was before the pandemic, showing that the economy isn't keeping up with the growing population. The year 2023 was especially tough. The UK's GDP growth was one of the slowest in the G7, ahead of only Japan. Inflation made things harder, hitting UK households worse than most other major economies. With rising prices, people had less money to spend, and businesses saw weaker demand. Certain industries have felt this more than others. Manufacturing, once a strong part of UK exports, is now struggling with supply chain issues and losing EU customers. The financial services sector, a key part of the UK economy, is also finding it harder to keep its global position after Brexit. At the same time, inflation has affected everything: food, energy, and everyday costs, leaving no one untouched. For years, the lack of a clear plan left big investors unsure, workers worried, and industries struggling to move forward. This issue has been quietly growing, but now it's impossible to ignore. By August 2024, the calls for action had reached their peak. UK manufacturers were firm without a proper strategy. The country's industrial strength would continue to weaken. They pointed to major problems that made it almost impossible to plan or invest for the long term. Trade union leaders also spoke out, saying that international manufacturers who once saw the UK as a great place to invest were now holding back. Why? Businesses didn't feel confident about the UK because there was no consistent plan or direction. Even as early as May 2023, experts had warned the government about the risks of not taking action. The UK was falling behind in global competition, with countries like the United States and Europe racing ahead in areas like renewable energy and advanced technology. Without a clear strategy, the UK was seen as an unreliable partner by global businesses. Some even called the government's actions flip-flopping, sending the message that this inconsistency could make the UK lose its edge in the global market. Finally, in October 2024, the government announced its Invest 2035 plan. It was introduced as a bold 10-year vision aimed at providing stability and giving businesses the confidence to invest in the UK's future. The plan looked impressive on paper, covering innovation, renewable energy, and workforce development, but the big question was whether it would actually work. The strategy's main focus was on innovation in technology. It aimed to make the UK a leader in fields like artificial intelligence, quantum computing, and biotechnology. But the competition was tough. Other countries were already spending billions in these areas. Could the UK catch up? Another key area was renewable energy. The government set big goals to expand wind and solar power by 2030. But here's the catch. Reports showed that the UK was on track to miss its clean energy targets by 32 gigawatts. That's not a small gap. It's the kind of problem that could completely derail the UK's plans for green energy. To meet these goals, quick investments and strong government support would be absolutely necessary. The plan also focused on workforce training and skills development. It admitted that without skilled workers, none of its goals could be achieved. New programs were introduced to align education with industry needs, including apprenticeship opportunities to build a skilled workforce for the future. But while this sounds promising, it's a long-term effort and results won't come right away. Even with its ambitious goals, the Invest 2035 plan faces serious challenges. The biggest concern is consistency, or rather, the lack of it. Businesses worry that sudden tax hikes or changing government priorities could ruin the plan's chances of success. In fact, when taxes were raised in the autumn of 2024 budget, surveys showed that many business leaders started looking at ways to cut costs, including freezing hiring. This kind of uncertainty directly goes against the plan's goal of encouraging investment and growth. Another big issue is energy infrastructure. The UK has one of the highest electricity to gas price ratios in Europe, making it expensive for businesses to adopt clean energy. If this imbalance isn't fixed, it could slow down progress on renewable energy projects which are critical for both the environment and the economy. Without solving these deeper problems, even the best plans could fail. So let's get real. Can the UK turn things around before it's too late? One of the government's main ideas is to explore joining the Pan-Euro-Mediterranean Convention. This agreement, already used by 25 countries, makes trade easier by standardizing rules of origin. In simple terms, it could mean smoother, tariff-free exports for industries like car manufacturing. It sounds like a good plan, easier access to markets and less hassle. But not everyone agrees. Some Brexit supporters see it as a step back, arguing it goes against the independence Brexit was supposed to deliver. The government is stuck in a tricky spot, trying to fix a struggling trade system without upsetting those who wanted to leave the EU. Another idea on the table is linking the UK's emission trading scheme with the EU's. Labour leader Sir Keir Starmer says this could help the UK reach net zero emissions more easily, increase market activity, and avoid problems caused by mismatched carbon prices between the UK and the EU. But this plan has sparked arguments. Critics worry that aligning carbon markets could give too much regulatory control back to the EU, which many see as a step in the wrong direction. Infrastructure is another area where the government is trying to make a difference. Projects like the Northern Powerhouse Rail and improvements to the Ely and Hawley junctions have been promoted as game changers. But progress has been frustratingly slow. Delays and funding issues have left people unimpressed, saying these projects aren't enough to tackle the economic challenges caused by Brexit. While these plans might sound good on paper, the reality on the ground feels very different. Economists haven't been kind in their reviews of these efforts. The biggest complaint? The reforms don't go far enough. Brexit has completely changed the UK's economic setup, creating trade barriers with its biggest trading partner. The numbers speak for themselves. The Office for Budget Responsibility reports that the UK's trade activity, as a share of its GDP, has dropped more sharply than in almost any other advanced economy. This is hitting businesses hard. Many industries are struggling to adjust to the new way of trading with Europe. The government is also under increasing pressure to renegotiate post-Brexit rules and work more closely with the EU. Experts are urging ministers to address the drop in trade by aligning the UK more closely with European standards. The Centre for Economic Policy Research says Brexit has added big barriers to trade, and the Office for Budget Responsibility paints a worrying picture. Over the next 15 years, UK imports and exports are expected to be 15% lower than they would have been if the UK had stayed in the EU. This kind of decline is a serious blow to the UK's economy, reducing productivity by an estimated 4% during the same timeframe. While the challenges faced by the United Kingdom since Brexit are undeniable, they also present opportunities for growth, adaptation, and reinvention. The setbacks in investment, trade, and innovation reveal a landscape in need of rebuilding, but the future is far from bleak if you look at it from a more hopeful angle. Efforts like the Invest 2035 plan and targeted reforms can still work out and help bring the UK back to economic success. With the right steps, precautions, and efforts towards UK's economy, a revival is possible in the near future.